All right, in this video, I want to talk about two topics. Uh, this video is not cover the entirety of these topics, but I want to talk about fiscal policy. So it's going to be part of 4.1, describe the fiscal policy of the government, revenue expenditure. And it's also going to be 4.11, explain the Keynesian policies. When we talk about Keynesian policy, we typically talk about fiscal policy. Okay, so if you hear Keynesian policy, think fiscal policy and characterize the actual economic policies. I'll save that for a later video when I will talk about the current monetary policy. I'll have one video dedicated to the Swiss fiscal supply side and monetary policy. Okay, so let's start. Before we talk about fiscal policy, there are two things that I want to explain. I want to talk about the government budget balance. The government budget balance is the difference between the money that has been received by the government, mostly taxes, but we'll see that there are other sources of income for the government, and the government expenses, the amount that has been spent by the government. We'll see that there are different areas of government expenditure. Simply the revenue minus the expenses. And of course, there are two possibilities. If the revenue is greater than the expenses, so we have received more money than what we have spent, then we say there is a budget surplus. On the other hand, when expenses are greater than revenue, we have spent more than what we have collected, then there is a budget deficit. Make sure you do not mix budget deficit with trade deficit. They have nothing to do together. And do not confuse a trade surplus with a budget surplus. Okay, so now what we should do is to identify the main sources of government income, government revenue, and the main areas of government spending. So whenever we talk about government revenue, well, in most countries, the majority, let's say close to 90% in most developed countries of government revenue will be through taxes. Okay? It's mostly going to be tax revenue. So remember, there are plenty of taxes. Of course, you have the direct taxes, including income tax, corporation tax, inheritance tax, capital gains tax. There are property tax. There are plenty of direct taxes that generate revenue for the government. But there are also indirect taxes, mostly VAT, but could also be some specific taxes that are imposed on specific products, mostly to discourage consumption. For example, there are some specific taxes on alcohol, on cigarettes, on gasoline, in addition to VAT. So that's the main source of government revenue, but we should also include the sale of let's say the revenue from public companies. You know, there are some public companies who produce and sell goods and services. And whenever they sell goods and services, the money that has been received is received by governmental authorities. We can also add the SWF, the sovereign wealth funds, which is basically any asset that is owned by the government. It could be the bonds from government bonds from other countries. Could be well, that's mostly what we're talking about, in fact. But it could be properties. Any asset basically that is owned by the government, and government can receive incomes. For simple example, if the Swiss government owns US government bonds, every 6 months or every year, Swiss government will receive interest payments on these bonds. So these are the main sources of income for a government. Now, how about the main areas of government spending? may be asked about, all right, what does a government do with the money that it has? Well, in most developed countries, the main areas, that's government spending. The main area would be what we call social protection. Social protection is essentially when the government gives benefits to the groups of the population who need some support, usually people who are the most vulnerable. So this includes things like child benefits, unemployment benefits, sickness benefits, disability benefits. It also includes pensions, public pensions for those who have retired. So any money that is just any transfer payment, any money that is given to people to just help them. Social protection. Another area is going to be healthcare, public healthcare, of course. Can be a quite substantial expenditure. In most developed countries, you have a public healthcare system. The government needs to spend a lot of money to build hospitals, to buy the equipment, to hire the doctors, the surgeons, the nurses, and all. So it's a big expense. You could have public education. Same thing, building schools, hiring teachers, and so on. And that costs a lot of money. An important element also is national defense and public order. That includes the army, the police, police officers. This includes like the justice system. You also have like spending on infrastructure, building roads, building railways, building electric lines, building pipes, anything that any mostly transportation and communication infrastructure that does cost a lot of money. And something that is called debt servicing, which is basically paying back the debt. If the government has a debt, we may have every year we have to pay back some interest payments on the debt that we have accumulated. Let me think. Healthcare, education, natural events, and there could be some subsidies to businesses. That's not the same thing as social protection. There could be the government may give some subsidies to businesses to encourage production, to support producers, to encourage growth, and so on. Okay, so these are the main areas of government spending. You should be able to identify them. Okay, so now that we have elaborated on the meaning of the main areas of government spending and government revenue, we can talk about fiscal policy. What it is, what's the influence that it can have, and we can also talk about the limitations. Okay, so fiscal policy. So fiscal policy is a demand-side policy, which means that it's going to influence the economy by shifting aid. We will see that it may have some supply-side consequences, but mostly fiscal policy is a demand-side policy that influences the economy by changing the level of taxes and spending. Okay, so there are basically two instruments that you can use. You have taxes and you have government spending. That's usually how we write taxes, government spending. If we increase taxes and if we decrease government spending, then we have what we call a contractionary fiscal policy. And we'll see that the higher taxes and the lower government spending will decrease AD. On the other hand, if we decrease taxes and we increase government spending, it's and or. and or. Then we have an expansionary fiscal policy. Okay, in that case, we will see that by cutting taxes and by increasing government spending, this is something that is going to increase aggregate demand. Let's write the formula for AD to better understand the impact of taxation and government spending on AD. So C plus I plus G plus X minus M. I'm not going to write everything, but I'm just going to go step by step. Okay, first, consumption can be affected by taxes, because of course, the more, especially direct taxes, okay? Because the more we tax, the higher direct taxes, the less disposable income households have, and therefore the less they can consume. It's quite clear how taxes can affect consumption. On the other hand, government spending can also influence consumption, because if we give more benefits to consumers, they will have more disposable income and therefore they will be able to consume more. Government spending can influence investment because governments can receive subsidies from the government to encourage them to invest. In that case, if the government increases spending to give more subsidies to businesses, this can lead to greater investment. On the other hand, taxes can also influence investment because, for example, if we increase corporation tax, which is a direct tax that is imposed on businesses, businesses will have less profit and they might be unable to invest, or at least they will invest less. Besides, if we tax profits, that the result may be that some investment projects are going to be less profitable, okay? If you have an investment project that is expected to produce 10% of profit, but you know that half is going to be taken away by the government, you may decide not to go ahead because, well, the net benefit or the net profit, what you will actually keep after the government has taken corporation tax, might not be sufficient. So G is, of course, government. So careful, it's not government spending in total, it's the government purchases. When the government spends money, say, on infrastructure, when it spends money on public health care, on public education, when the government actually produces or purchases or supplies a particular good or service, it does not include welfare benefits. Well, that's quite obvious. The more the government is going to spend on education, healthcare, infrastructure, the higher G and therefore the higher aggregate demand. And X minus M, there can be some export subsidies, which are subsidies that are only given to firms if they export their products. That's something that can boost exports. And in fact, even subsidies to businesses can encourage them to export more, but in that case, it would shift AS, not AD, so never mind. But also, governments, they sometimes introduce taxes on imports, which we call tariffs, in order to make imports more expensive and to discourage imports, okay? By taxing imports, you make them less competitive, so you reduce imports and you can boost exports. Okay, so that's basically the way in which government spending or taxation can influence the multiple components of AD. So you understand that, of course, more government spending or less taxes will lead to an increase in AD. Less government spending or more taxes will lead to a decrease in AD. So what's going to be the consequence on the economy? Well, it depends. I'm not going to draw all possible diagrams, but it truly depends on the type of model, and please refer to your notebook to look at all the possible cases, but essentially they are many different possibilities, depending on whether we are in the monetarist model or in the Keynesian model. And in the monetarist model, there are two sub-cases that you have to consider. The short run, when You have the SRAS, which is upward sloping. And the long run, when the long run negative supply is vertical. Of course, the consequences of an increase in AD will not be the same. And in the Keynesian model, in fact, you have 3 cases to consider. You would have, of course, in the exam, you're not going to draw all diagrams, but you can mention that the consequences depend on the type of model considered, if we're in the short run or if we're in the long run. And in that case, what matters is spare capacity. So when we have large spare capacity, so when we are, like that's when you are somewhere here, when you have low spare capacity, so when you are somewhere here, and finally, when you have no spare capacity, when you are here, okay? Horizontal section, upward sloping section, and vertical section. So that's a lot, and in class we've analyzed all cases, and what we did is that we looked at, all right, in the case of an expansionary fiscal policy, AD increases, and we looked at what happened in all possible cases, and we've done exactly the same thing in the case of a contractionary fiscal policy when AD decreases. And in terms of the consequences for the economy, we mostly considered 3 elements. Okay, I can erase that. Which are the 3 key macroeconomic objectives, and which are the 3 elements that you really have to discuss when you analyze an ASAD model. Number 1 is economic growth. Basically, are we going to produce more or are we going to produce less? We just look at the horizontal axis. Number 2, unemployment. Are we going to have more or less unemployment? It always goes together with economic growth. If we have economic growth, we produce more, we need to hire more people, and therefore unemployment decreases. On the other hand, if we produce less, we need fewer people, and therefore unemployment will go up. And then you have inflation. Will the price level increase? Will the price level decrease? Remember that when the price level decreases, you should say something like lower inflationary pressure rather than calling this deflation. It's okay, low inflation. But make sure you understand the difference between disinflation and deflation. So in all those 5 cases, short run, long run, low spare capacity, medium spare capacity, and no spare capacity, you have to, and in 2 cases, contractionary and expansionary fiscal policy, you need to be able to discuss the consequences of fiscal policy. Again, please refer to your notebook so you have all the possible diagrams. If you had to choose one, I would choose the short run monetarist model. The one that is like that, because it's easy. It's quite easy to draw and easy to explain. Okay. Right. Something that you could mention is that despite being mostly a demand side policy, taxation and government spending can also have an influence on AS. You can simply mention it briefly because that's mostly a supply side policy. But you could say that, oh, well, of course, if the government decides to spend more on education, that can increase AD, but that can also increase AS in the long run because people will be more productive. They will have more human capital. Same thing, if you spend money on healthcare, the labor force is going to be more productive, and people who are more productive, that leads to a situation where AS is going to increase as well. Same thing, if firms they subsidize or they encourage investment by giving subsidies or by lowering corporation tax, of course it's going to shift AD, but as it changes the investment decisions of businesses, it can also influence AS. So you see that, or keep that in mind. Understand that a fiscal policy may also be accompanied with changes in AS, and usually an expansionary fiscal policy, of course, it increases AD, but it can also increase AS at the same time. like spending on education, on healthcare, better infrastructure. Okay, if the government spends more on infrastructure, funds will be able to produce more efficiently, and so AS can also increase. Okay. Now, to conclude, fiscal policy, perhaps we can talk about some of the limitations of the issues we may encounter whenever it comes to assessing fiscal policy. Number one, that mostly for an expansionary fiscal policy, we can have a problem with the public debt, especially. So that's mostly for an expansionary fiscal policy, because obviously if you tax less and if you spend more, this can result in a budget deficit. So in that case, in order to finance this budget deficit, you will have to borrow. And as you borrow money, your public debt may increase, which can be concerning because, of course, it means that every year you will have to pay interests on the debt, and this cost, the fact that you have to pay money every year to pay back the debt or to pay the interests, has an opportunity cost in the sense that you could have done something else with this money. Another problem with fiscal policy is the existence of time lags, because well, this is a policy that is not instantaneous. It takes time, and there are three main lags that you must know. The recognition lag, the time it takes for the government to recognize the state of the economy. The decision lag, the time it takes for the government to actually make a decision to design an economic policy. And the implementation lag, the time it takes for the policy to actually become effective. Which is, I remember I compared with the example of a disease. If you are sick, it may take some time for you to become aware of the disease that you have. Then once you are aware, and once you've seen a doctor, the doctor may need some time to decide what the best treatment is. And even once we have started the treatment, it can take time. So okay, these are the three time lag that we are facing, and that can undermine the effectiveness of fiscal policy. Another limitation is the crowding out effect. The crowding out effect is an important limitation of fiscal policy, and it's based on the idea that that's mostly for expansionary fiscal policies, that when the government spends more than what it has, there is a budget deficit, and so the government must borrow money. And as the government borrows money, this is something that will increase the rate of interest, okay? Because imagine there is a market where there are some people who are willing to lend money, and there are some people who are willing to borrow money. So there is a supply of money, those who are willing to lend, and there is a demand for money, those who want to borrow. And if the government needs to borrow more money because it has a budget deficit, then the demand for money will increase in this market, and so the equilibrium price will go up. And in this market, the equilibrium price is the rate of interest. So as the government borrows more money, the rate of interest goes up. Why is it a bad news? Well, it's a bad news for businesses, for private businesses, because the fact that the rate of interest is higher makes it more expensive for them to borrow, and even households, right? Like households and private firms will find it more expensive to borrow. The consequence can be a decrease in consumption because households, they borrow less than before, and a fall in investment because firms find it more expensive to borrow as well. So these are the key. I'm not going to say more than that because I feel like these are the main ones. And perhaps even if I feel like it's a bit redundant, but we can say a few words about the main advantages. Main advantages, well, number one, something that is pretty cool about fiscal policy is that you can target specific groups of the population. Can target certain groups of the population because you can decide who you want to give the subsidies to, for example. You can decide on what items you're going to purchase. Are you spending more on education, more on healthcare, more on infrastructure? Are you giving more benefits to what type of benefits do you want to increase? So it's very precise in the sense that you can really fine-tune this fiscal policy to cater the needs of your economy. One important benefit of fiscal policy that you should mention is the multiplier effect. So the multiplier effect is a simple idea which basically tells us that when the government spends a given amount of money, then at the end of the day, the national income will increase by more than this basic amount. And this is how it goes. Let's say that the government decides to spend $1 million to build a new building. Okay, so plus $1 million. So that's already an increase in national income. But then this money is going to be received by whoever was involved in the construction of this additional building, right? Let's say the construction workers, the shareholders of the construction companies, all of the factors of production, or whoever owned the factors of production that were involved in the construction of this building received this money. Of course, what are they going to do with it? Well, they may save some. Let's say they save $200,000 and they consume $800,000. Before anything, some will buy new cars, some will buy new houses, some will buy, it doesn't matter, right? But those who have received the money from the government in exchange for constructing the building will spend this money on anything else. So, now we have other people who have received more money. And same thing, they are going to save some, let's say $100,000, and they are going to consume more. And so more people will receive more money. And so you see at the end of the day, when you add up the total amount of money that has been received by people in the economy, it's much more than $1 million. Okay, it's $1 million plus $800,000 plus, and you continue on and on and on and on, because the money has been spent several times in the economy. Okay, and so that's the idea, which means that if the government wants to increase GDP by $10 million, it does not have to spend $10 million. Perhaps just $5 million is enough, because the money is going to be spent several times. But of course, you see that every time more income is being received, some of it is going to leak in the form of savings, in the forms of imports, and in the forms of taxes. Okay, that's why the more leakages we have in an economy, the lower the strength of this multiplier effect. Can I add a last one? It'd be nice to have 3 and 3. You can target specific groups of the population. That's Let me check what we wrote to see if I haven't forgotten anything important. Well, I haven't really forgotten anything important apart from the fact that, yeah, okay, so you can achieve the key macroeconomic objectives, of course. The key macro objectives. When there is a recession, you implement an expansionary fiscal policy that increases economic growth and that decreases unemployment. That's great. When there is like high inflation, for example, you introduce a contractionary fiscal policy, and so you reduce inflation. But perhaps we can add as a disadvantage, I'm not going to write it, but as a disadvantage, you see that you can never, almost, unless if you are in the Keynesian model with large spare capacity, but in most cases, there's a trade-off between those macroeconomic objectives. It's difficult to achieve all 3 of them at the same time. So it's either growth and high growth and low unemployment, or low inflation. Because as you shift, as you increase AD, okay, you boost growth, you reduce unemployment, but that causes demand for inflation, right? And when you cut AD, all right, you do reduce inflation, which is great, But the problem is that this is at the expense of economic growth and low unemployment. So there is often a trade-off between those key government macroeconomic objectives, and that is something that that can be regarded as a disadvantage, especially as we compare fiscal policy and demand side policies to supply side policies. But yeah, that's about it for fiscal policy. You know everything that is important.